Hey investor friends, I'm Michelle Markey, and today I'm going to be talking about why I think Roth IRAs are better than traditional IRAs and pre-tax 401ks. I'll make a special note about Roth 401ks as well. And for anyone who doesn't know, IRA stands for Individual Retirement Account, and you can get these retirement investing accounts in the US, and they're pretty useful for anyone who hopes to have a nest egg built up in retirement and it's tax advantaged in certain ways. So you can choose to either contribute pre-tax money or after-tax money, depending on which retirement account vehicle you use. And as a quick little tip, usually you get a 401k from an employer or at your job, and there's often what's called an employer match, where if you contribute a certain amount to your 401k, your employer will often match that amount as well. And it's not always the case. There are definitely 401ks that are set up without an employer match, but that can be pretty useful if you're looking to contribute either pre-tax or post-tax money. And then with IRAs, you can usually contribute pre-tax money to your traditional IRA, whereas you contribute after-tax money to your Roth IRA. The following is my opinion that I'm sharing from my own personal experiences, so please don't take this as advice. It's just for education and entertainment purposes because everybody's life situation is different. You may have different tax and retirement goal considerations than I do, so please take what I'm sharing as just something that I'm trying to be helpful with and what I'm doing as a course of action in my own retirement plans. And if you're enjoying the coaching of you and myself, please smash that like button because it greatly helps out my channel, and I'd love if you could please subscribe as well. And thanks. Also, if you'd like to learn more about tax advantage investing accounts, please feel free to check out my videos on things like IRAs, 401ks, and health savings accounts, because these are all tax advantage investing accounts that can help you save up not only for retirement, but in the case of HSA or health savings account, can help you save up for medical expenses. So feel free to watch those videos and also check out my website, michellemarkey.com, where I have free resources that go through in great detail the benefits and special considerations of each of these types of investing accounts. So the main reason why I think Roth IRAs are superior to the other iterations of either IRA or 401k is because of the required minimum distribution rule. And this recently changed at the end of 2019 and went into effect in 2020, where it used to be when you were 70 and a half, you had to take a required minimum distribution from either a traditional IRA or pre-tax and post-tax 401ks, and that changed to age 72 as of 2020. So now you are required to take out a minimum amount of money each year from those other retirement accounts except the Roth IRA. And because of that and the tax implications associated therewith, that's the biggest game changer for me of why I consider the Roth IRA to be the best way to go. I think the common investing wisdom generally makes sense when it comes to the major benefits of a Roth IRA and the traditional IRA or pre-tax 401k. So usually the thinking goes is that it's better to contribute to a Roth IRA when you're in a lower income tax bracket, because even though you're paying taxes on your after-tax contributions to the Roth, it's worth it because then you get to invest that money tax-free and enjoy tax-free withdrawals in retirement, which is great, as opposed to maybe it's better to invest more in a pre-tax 401k or a traditional IRA if you're in a higher income tax bracket now, so that you're not paying taxes on those contributions, but then you have to pay taxes on it when you withdraw during retirement at a certain age. So that common advice is generally sensible, but the thing is, if you have a sizable amount of your nest egg in your IRA or 401k that's pre-tax money, and it's in the amount of say $2 million or $3 million in your 70s, 80s, and 90s, you get progressively taxed more and more in that required minimum distribution, because every year the amount that you're going to have to take out of that account goes up based on the IRS's lifetime expectancy factor, based on its lifetime uniform table that you can look up. And this made me realize that RMD is intense if you really take the calculations of tax rates applied to that, assuming you also collect Social Security benefits, income, and the amount of taxes that you end up paying from age 72 to age 90 is a lot. And that's the principal reason why I'm in extreme favor of doing everything as Roth as possible, and that includes both 401k and IRA. I've always been a fan of the Roth IRA ever since my older cousins explained the benefits of it to me. So when I was 18, I opened my Roth IRA as soon as I could and have been contributing as much as I can to it ever since. And then I've been fortunate to have employers who have offered not only a 401k but also a match to go along with it. So I take advantage of both of those main retirement vehicles. And with the 401k, the main thing is I struggled to decide over the years whether I preferred investing in pre-tax or after-tax, and that's in the form of doing either the regular or traditional 401k versus the Roth 401k. And initially I thought Roth is better. Let me just contribute money to the Roth 401k, but then it took out a huge chunk out of my paycheck, and I thought, this isn't so fun. Let me just contribute the pre-tax amount instead. And then I thought by contributing only the minimum to my pre-tax 401k, I could invest the rest of my paycheck minus my life expenses in an individual investing account that's fully taxable. And I realized this was a little bit of foolish thinking, because in being fully taxable, let's say my income tax bracket was 22%. So if I had any short-term capital gains of buying and selling any stock in under a year, I would owe 22% in taxes on those capital gains of that stock, let's say. And then if I decided to hold that stock longer than a year, I'd end up owing 15% on long-term capital gains if I sold it after, say, a year and a half. And I realized this was a little silly for me to be investing in individual accounts, although I still do it. But now I realize that I should really focus a lot of my energy on taking as much advantage by maxing out my 401k and Roth IRA as much as I can. I didn't used to think about the long-term implications of my retirement investing decisions, and I'm talking real long-term, like age 70 and up. And I also think that this is kind of new to some baby boomers, because some of these retirement investing accounts only came about when they were our age. Like the traditional IRA came around in 1974, and then the 401k was created in 1978 and went into effect in 1980, followed by the Roth IRA, which has only been around since 1997. So I don't know if anyone's really thought about the long-term effects that investing in these accounts can have over the course of 30 to 50 years, and what that means while we're living life during our old age. So I take us through the following spreadsheet where I explain how if you are age 25 and let's say you're making a $75,000 gross salary, what this means for you depending on what investments you choose to make. And this person, age 25, works until they're age 75. And I know that probably seems beyond the age at which someone should be working, but please hear me out for the purposes of this example. And let's assume they get a net salary that's subtracting 34% of all paycheck withholdings and taxes. And that includes things like their 401k pre-tax contributions, health and dental insurance premiums, and federal and state taxes. So out of a $75,000 gross salary per year, they're left with a net of $49,500 per year. And let's say they contribute the max that they can to their Roth IRA of $6,000, and then they also are contributing the minimum amount to get the employer one-to-one match on the minimum contribution amount, which is, in this example, 4%. And 4% of $75,000 is $3,000. So in total, this person has $6,000 contributed to the 401k in a pre-tax kind of way. And you'll see I compare these two columns D and F as we go down along the calculation and see how they fare over time. And just to point out, I also factor in the total taxes slash other that you have to take out before you get to the after-tax contribution amount. So what I mean by that is, in order to contribute an after-tax amount of $6,000, I had to subtract 34% from a gross amount, which happens to be $9,000. And this amount kind of changes a little bit when the person is age 50 and starts contributing $7,000 per year to their Roth, and the amount of that tax is slightly more. So when I add up the amount of taxes that someone effectively would have paid in order to contribute after-tax amounts, it adds up considerably. So scrolling on down in this spreadsheet, and you can feel free to pause it if you want to look at any particular cell, and the Roth IRA and 401k pre-tax are earning the stock market's historical rate of return of 7% to be on the conservative side. And this is growing until, let's stop at age 72, where you really see the impact of the required minimum distribution. And at this point, the Roth and 401k look like they're very close in the total amount that's in it between the earnings and principal, where you have 2.17 million in the Roth IRA and you have 2.12 million in the 401k. And you would have contributed much more to the Roth, obviously, than what you contributed to the 401k. And you paid a significant amount of taxes on your contributions to the Roth so far. And in total, by the time you stop working after age 74, you are at a total of having contributed $325,000 to the Roth and having paid around $167,000 in taxes. And then with the 401k, you would have only actually had to contribute $150,000. But then you see the effects of the RMD, and it requires you to take out certain amounts. So the amount that's taken out of the 2.12 million isn't an amount that you can invest anymore, and that becomes part of your ordinary income. And I'll try to spare you the details of all the taxes, but it actually causes your income and tax rate to go up. So you're made to basically live on more money that was required to be distributed from the 401k, versus if you wanted to with a Roth IRA, you could just continue living on $75,000, let's say, by only taking out $39,000, and the rest of it comes from $36,000 in Social Security income. And that was also added to your 401k amount. And when you compare the final amount, by the time you're 90, this will result in having $6.3 million in the Roth IRA versus $2.8 million in the 401k. And I think that's a pretty significant difference of over $3.5 million. And in total, adding Social Security income taxes to both the Roth IRA and the pre-tax 401k, the total amount of taxes paid in having a Roth IRA was $231,000 compared with paying $703,000 in having the pre-tax 401k. And a lot of that is a result of the taxes on the ordinary income that resulted from the required minimum distribution. And even though the pre-tax 401k had a slightly better rate of return compared to the Roth IRA, I consider the difference of $472,000 in the amount of taxes paid to be incredibly breathtaking in how much the pre-tax kind resulted in paying way more taxes over the ages of 72 through 90. And whether you're doing the pre-tax 401k or doing a traditional IRA, the result is very similar because of the required minimum distribution effect. And for that main reason, I think it's way better to invest, if you can, in the Roth 401k. So even though you risk having to pay required minimum distributions if you keep that 401k, what you can do is roll that Roth 401k over into a Roth IRA so that you don't have this RMD situation going on. And I think that that's actually the best way to go. What I also love about the Roth IRA is that I can invest in just about any kind of asset, whether it's stocks, bonds, ETFs, index funds, whatever it is, and I have the ultimate freedom of choice. And that's the only caveat that I don't get with investing in a 401k, is that often there's only so many kinds of mutual funds or fixed income fund that I can invest in when it comes to a 401k. And that makes me feel a little bit uncomfortable because I don't always understand all of the companies that are in a particular mutual fund, and also the expense ratio fees are a little bit higher by investing in some of the 401k mutual funds as offered by the employer. And it's not their fault. I just think it's probably the way it is. And also, if I contributed any pre-tax money to either a 401k or a traditional IRA in the past, I can convert that via backdoor conversion into a Roth IRA. I just have to be able to pay the income taxes that are resulting from that converted amount. And that's another option to have if I want to have the ultimate freedom in investing all of these funds, whether they're originally coming from a 401k or IRA, into a Roth IRA in the end. To summarize, all roads lead to Roth IRA in order to avoid RMD at age 72. And I've got 3 options of my preferred way to maximize my contributions to my retirement investing accounts. And they include option number 1, with contributing $6,000 a year to my Roth IRA and $19,500 to my Roth 401k, and then eventually rolling over the Roth 401k to a Roth IRA. And then option number 2 is similarly contributing $6,000 a year to the Roth IRA and then doing the minimum match with a Roth 401k, let's say $3,000 a year, and then eventually rolling that over to a Roth IRA. And then option number 3 is also Roth IRA again, max, and then doing a traditional or pre-tax 401k, let's say $3,000, but then rolling that over to a traditional IRA and then backdoor rolling that over into a Roth IRA. But in general, I try to avoid contributing to pre-tax traditional IRA or 401k, and that helps me to be able to maximize my investments and earnings in all the Roth vehicles. And talk about delayed gratification. I know that's a lot to have to think about and could be overwhelming, so think it over and please let me know what you think in the comments. And if you enjoyed this video or learned something, please like and subscribe. And I look forward to talking with you about more investing and personal finance topics in the future. Till next time.